Hi everyone, and welcome to a short video on accounting for long service leave. The key issue with accounting for long service leave is how to determine the change in the liability to be recognized in the balance sheet. Long service leave is a payment to an employee after they have worked a set number of years with their company. The number of years required is determined by each company, but is typically between 10 and 15. Once an employee is eligible, they can either take leave, or in some cases opt to take the leave as a cash payout. Unlike sick leave, for example, long service leave will be paid to the employee if they are eligible and they leave the company. AASB 119 covers employee benefits. There are 4 types of employee benefits, of which long service leave comes under other long-term benefits. In terms of recognition and measurement, paragraph 155 links to paragraphs 56 to 98 and 113 to 115, which deal with defined benefit plans. The essence of this, which can be found in paragraphs 56 to 65, is that the entity needs to determine the deficit or surplus in relation to the plan, and then recognizes this as a liability or an asset. But what is the defined benefit obligation in this case? The defined benefit obligation is the amount the employee is going to receive as long service leave at the point in time in which he or she becomes eligible. It is defined because the amount they will receive is based on their salary at the time they are eligible. Let's have a look at how we go about calculating the long service leave liability at the end of the year. In this example, Bill has worked for the company for 8 years, and he will receive 10 weeks leave once he has worked for 15 years. However, he is also entitled to a pro rata payout at 12 years. Without a pro rata payment as part of his contract, if Bill left any time before 15 years of employment, he would not get a cent. However, with a pro rata payment, he will get something if he works for at least 12 years. The other information available is that Bill's current salary is $83,119. His salary is expected to grow at 6% per annum. The probability of Bill still working in 4 years is 60%. The discount rate is 7% per annum. And the opening balance of the provision for long service leave is $2,000. Let's look at this on a timeline. As a side note, I'm a big fan of timelines, as they'll often help you to get a good feel as to what is going on when. Anyway, back to the example that we have here. Bill has worked for 8 years. At time 15, he will have earned 100% of his long service leave, but because of the pro rata payment at time 12, that is when the company first becomes obligated. As such, we need to determine how much the obligation is at time 12, and then discount it back to a present value. Step 1 is work out Bill's expected salary at time 12. This is because the leave payment at time 12 is based on his salary at that point in time. His current salary is $83,119, and a 6% per annum growth translates to a salary at time 12 of $104,936. Step 2 is to determine the amount of leave earned. Whilst Bill's future salary is $104,936, this is for a full year, whereas he only gets 10 weeks leave. In addition, he gets 100% of his leave once he has worked 15 years. He has only worked 8, so that needs to be taken into account as well. To calculate leave earned, we multiply future salary by the weeks leave he gets. In this case, that is 10 over 52. Then multiply this by the amount he has earned, which is 8 years, divided by 15 years. You'll end up with $10,763. Step 3 is to determine the present value of the leave earned. The $10,763 calculated on the previous slide is a future amount, but we need to represent this on the balance sheet in today's dollars. So using the discount rate of 7%, which was provided, discount the $10,763 at time 12 to $8,211 at time 8. Step 4 is to take into account the probability that Bill will actually still be at the company in 4 years' time. If he isn't, then he won't get anything in relation to his long service leave. In this case, the probability of Bill still working in 4 years is 60%. So this means there is a 60% chance of a payout of $8,211, and a 40% chance of a payout of nothing. This means the long service leave liability, which is on the balance sheet at the end of the year, is $8,211 multiplied by 60%, which equals $4,926. This slide sets out what we've just done. Step 1. Work out the expected future salary. Step 2. Work out long service leave earned. Step 3. Work out the present value of the long service leave earned. And finally, Step 4. Work out the balance of the provision for long service leave based on the probability of Bill still working there. The entries are straightforward. The difference between the opening and closing balance is either debited or credited to the provision for long service leave account. In this case, it is credited as the provision is increasing. According to paragraph 156, the change will get taken through profit or loss, unless another standard requires or permits its inclusion in the cost of an asset. If there is no pro rata payment, it works out similarly, but instead of the obligation occurring at time 12, it occurs at time 15. This will affect the number of years you use for both calculating the expected future salary and in discounting to a present value. It will also affect the probability provided, as we'd need to know the probability of Bill still being at the company in another 7 years' time, not just 4. In conclusion, long service leave is an employee benefit under AASB 119. In terms of practical issues, you need to consider when the company is first obligated. Then when calculating the long service leave liability, you'll need to A. Determine salary at the time of the obligation, B. Determine the leave earned at that time, C. Calculate the present value of the leave earned, and finally, include the probability of a payout.